the bank reconciliation that revealed fraud. I was doing a year-end bank reconciliation for a client last week, and I found $47,000 in fraud that had been happening for 18 months. The business owner had no idea, and it would have kept going if we hadn't been doing proper reconciliations. I'm Bev from bookkeepingcoach.net. In 30 years of bookkeeping, I've uncovered over $2 million in fraud across different businesses. And I hate finding it every single time. But proper bank reconciliation is the #1 way fraud gets caught, if you know what to look for. Here's what I found with this client. They have a bookkeeper who enters transactions and reconciles the bank account every month. Everything looked fine on the surface. The reconciliation always balanced. But I was brought in to do a year-end review. And I noticed something odd. The cleared checks list had 3 checks to the same vendor in 1 month. Same vendor, similar amounts, all within a week of each other. I pulled the actual bank statements. Those 3 checks were there. They cleared. But when I looked at the vendor bills in QuickBooks, there was only 1 bill that month to that vendor, not 3, 1. That's a red flag. I went back through the entire year and found this pattern repeating. Extra checks to this vendor that didn't match any bills in the system. The total, $47,000 in unauthorized checks over 18 months. Here's how the bookkeeper did it. They would enter a legitimate vendor bill in QuickBooks, then they'd print 2 checks, one for the actual bill and one extra they'd keep for themselves. They'd forge the signature or had check signing authorization. In QuickBooks, they'd mark the bill as paid with 1 check number. The second check wouldn't show in QuickBooks at all, but it would clear the bank. When they reconciled the bank account each month, that extra check would show up as unclear in the reconciliation. Most people would either ignore it or blindly click it as cleared just to make the reconciliation balance. The business owner never looked at the detailed reconciliation reports. They just asked, does the bank account balance? And the bookkeeper would say yes. But a proper reconciliation doesn't just check if the ending balance matches. It checks if every single transaction matches between the bank and QuickBooks. This went on for 18 months, $47,000 stolen. And it only stopped because I was brought in to do a detailed year-end review. The business owner was devastated. This was a trusted employee, 8 years with the company, someone they never suspected. And now they're dealing with police reports, insurance claims, and trying to recover the money. But here's what's really important for you to understand. This isn't unusual. According to studies, 85% of fraud is committed by trusted employees, not strangers, people who've worked with you for years, people you trust completely. The average small business fraud goes on for 18 months before it's discovered. The average amount stolen is $150,000. This client actually caught it relatively early. And here's the scary part. Most small business fraud is never reported publicly. Business owners are embarrassed. They don't want customers or competitors to know. So you never hear about it. But it's happening constantly. I find fraud in about 1 out of every 10 businesses I review when I'm specifically looking for it. 1 in 10. Almost all of it could have been caught much earlier with proper reconciliation reviews. So what needs to happen with bank reconciliations to prevent this kind of fraud? First, reconciliations need to be done monthly, not quarterly, not when you get around to it. Every single month, within 10 days of month end. This is non-negotiable. Second, the reconciliation needs to be reviewed by someone other than the person who does it. If your bookkeeper reconciles the account, the business owner or manager need to review that reconciliation report. Not just ask if it's done, actually review it. Third, you need to check for unusual patterns. Multiple payments to the same vendor, round number checks that don't match months is suspicious. Either it's a data entry error or it's fraud. Either way, it needs investigation. Fifth, credit card reconciliations are just as important as bank account reconciliations. I found fraud hiding in credit card accounts because nobody ever reconciled them. They just recorded the payment when they paid the bill. Sixth, you need proper segregation of duties. The person who writes checks should not be the person who reconciles the bank account. But I see this in 70% of small businesses. It's an open invitation for fraud. And seventh, this is critical, you need to actually look at your bank statements, not just the summary. Look at the check images. Look at who signed them. Look at the payee. Embezzlers count on owners never looking at the details. There are 12 additional checks I run when reviewing bank reconciliations, specifically looking for fraud. Most bookkeepers don't even know these checks exist. And here's something most business owners don't realize. Fraud doesn't just cost you the money that was stolen. You lose time dealing with the police and lawyers. You lose trust in your team. You lose sleep. Your insurance premiums go up. And if the employee took money that should have gone to payroll taxes or sales tax, you're still liable for those payments to the government, even though the money is gone. The real cost of a $47,000 fraud is closer to $75,000 when you add everything up. So where does this leave you? Option one, you trust that your bookkeeper is doing reconciliations correctly and honestly. This works great until you discover $47,000 is missing and it's been happening for 18 months. Option two, you learn what to look for in reconciliations and review them yourself every single month. This works if you have the time and know what the red flags are. Option three, you bring in someone periodically to do detailed reconciliation reviews, specifically looking for fraud indicators. This is what most of my clients do. Quarterly or semi-annually, I review their reconciliations with a fraud detection lens. The key is having someone other than your bookkeeper looking at the reconciliations. Because if the same person reconciles who does the reviews, there's no check on their work. If you've never had someone review your reconciliations specifically looking for fraud indicators, or if you want to know whether you're vulnerable, I can help. I do bank reconciliation and fraud detection reviews where I look at your past 12 months of reconciliations. I check for all the red flags that indicate fraud. I verify that everything that should have cleared actually cleared. And I tell you exactly where you're vulnerable and what controls you need to put in place. I've put a link in the description below where you can book a call with me. We'll talk about your current reconciliation process, who's doing them, who's reviewing them, and whether you have the right controls in place to prevent fraud. Early detection is everything with fraud. The longer it goes on, the harder it is to recover the money. The link is in the description to book a call. Fraud doesn't announce itself. It hides in the details that nobody's checking. Your reconciliations either protect you or they don't. There's no in between. And the longer fraud goes undetected, the harder it is to recover. The employee spends the money, the trail gets cold, evidence disappears. I know this is an uncomfortable topic. Nobody wants to think their trusted bookkeeper might be stealing from them. But the statistics are clear. It happens a lot. Subscribe to the channel for more bookkeeping security and fraud prevention tips. The link is in the description if you want your reconciliations reviewed. I'll see you in the next video.